Onto your markets news now. Asian stocks were mostly down, with Chinese shares the main drag on the day. This was despite a Chinese market regulator pledging that it would crack down on market manipulation and that it would protect small investors. Comments made by former President Donald Trump around imposing tariffs of more than 60% on Chinese imports if re-elected was one of the issues or one of the number of factors that negatively affected sentiment, while more recently China's service sector data showed a slower growth rate in January. The Nikkei share index rose by 0.5%. The Hang Seng index ended the session down 0.15%, while over on mainland China, the Shanghai Composite Index declined by just over 1%. Over in the United States, Wall Street ended sharply higher on Friday. The S&P 500 registered another record closing high. All three major U.S. stock indexes rose on the back of strong earnings and a blowout January jobs report. The non-farm payrolls report from the Department of Labor showed that the U.S. added 353,000 jobs in January, blasting past analyst estimates, while wage growth unexpectedly also heated up. The S&P 500 gained 1.07%, the Nasdaq Composite gained 1.74%, and the Dow Jones Industrial Average rose by 0.35%. Markets in Europe are mixed at this hour. Britain's FTSE 100 has added 0.3%. The Paris CAC 40 in France is slightly down, and Germany's DAX is flat. The JSE was mainly weaker at midday. The all-share index is flat at 74,472. The Industrial 25 index is slightly down. Financials are 0.7% higher, and the Precious Metals and Mining index is 1.4% lower. The rand is trading at around 18.96 against the dollar, 23.93 against pound sterling, and 20 rand 37 against the euro. Looking at commodities, gold is trading at $2,021 and platinum at $896 per ounce, while the price of Brent crude oil is hovering at around $77 a barrel. Well, to unpack the markets for us, I'm joined by Gary Boyson. He's a portfolio manager at Rand Swiss. Thanks very much, Gary, for joining us. So a couple of things in the United States. Tech shares saw the key indexes hit all-time highs, and the U.S. non-farm payroll data showed that 353,000 jobs were created in January, much more than the market had expected. Just unpack what this means, and I suppose it means interest rates higher for longer in the United States, at least.
Yeah, higher for longer, definitely. I think it's one of the reasons that you're seeing the financial index up 0.7 today. Resources on the back foot in spite of that mining indaba. But you mentioned that 353,000 number in January. It's not just the 353,000 number. It's the revision that we saw in December as well. So 333,000 jobs added in December. Just this labor market in the US is absolutely unstoppable. It is very, very difficult to see how the Fed is going to push through interest rate cuts until you see some real wage price inflation coming and threatening the inflation outlook. So we did see a big shift in the underlying perception. So if you look at the federal funds futures, if you look out to the March meeting, there's now an 86% chance that we'll see no change in March. The market is still expecting around a 60% chance that we'll see the first interest rate cuts in May, and around a 93% chance that we'll see the first interest rate cut by June. So clearly thinking that we're going to see, I don't know what they're thinking they're going to see. Like, inflation really, really moderating, firmly on that target path back to 2%. Because with a labor market like that, it's difficult to see how that's possible.
So what's happening over in China? The stock market there has been on a downward spiral for quite a while. Does this speak to the second largest economy's bad or not so great fundamentals?
I don't know if it's the fundamentals, but it's certainly the investment sentiment around China at the moment. So Goldman Sachs held a conference recently, I think it was last Wednesday. In the China session, they surveyed the investment audience, and 40% of the audience said China is uninvestable. We've seen a true $1 trillion wiped off their listed markets. This January has become the first January where foreigners have been selling out of Chinese equities since 2014. So investors clearly not liking the underlying Chinese story, and I think there's a couple of factors. you can point to weaker fundamentals. I think longer term China will have a demographic issue. Their working age population already is aging. We've got kind of the ongoing property crisis. We've also got regulatory uncertainty. I think everyone is still a little bit battered and bruised from the regulation that we saw around certain sectors, specifically the education sector, but around tech more generally. But I also think that probably the key factor that people maybe aren't talking about is just the rising tensions between Beijing and Washington. So you look at it, the US is banning all sorts of high-end equipment sales. They're really trying to protect themselves from China getting access to cutting-edge technologies. So the big tech companies that China was managing to grow do seem to be stifled by kind of the ongoing trade war going on in the background. And I think that has also made it very difficult to invest in Chinese equities.
So here at home, we have the mining indaba underway. We know that the mining sector really hasn't been doing so well. There are issues around logistics. I'm talking about the local mining sector, logistics as well as load shedding. We know that the industry has heavily invested in renewable energy in order to try and be more independent in that regard. But they haven't been doing well, and that's been reflected in the stock market. So at the mining indaba, how investable does South Africa actually look? And what are your thoughts? I mean, given that valuations are currently low, would you put your money there right now?
Well, I think if you look at the listed resource counters that have come off, that's largely on the back of commodity prices and a normalization, I think, after the Ukraine, the initial ramifications of the Ukraine-Russia conflict. And we have seen, with commodity prices low, as you would expect the stock prices to be lower. But I think that's not what we should be looking at. What we should look at is that, if you look at exploration funding, which is what you want to develop new mines and really, increase the ability of the sector to create jobs and to be profitable and be good for shareholders as well. We attract less than 1% of global mining funds available for exploration. And I think that the mining indaba it really is our opportunity to showcase why we should be an investment destination. The big challenge, I think, isn't really the commodity price cycle. It's far more to do with the policy uncertainty that we're seeing in South Africa. So whenever you're building a mine, this is a very long-term project. You need to have a huge amount of trust between the mining organization and the government or the territory that they're investing in. It's all well and good sinking billions and billions of rand into shafts and setting up machinery and bringing in expertise. But if you can't be assured that you are going to benefit from all this work down the line when that mine becomes profitable, it's very difficult to make that investment. So I think it's for us to convince everyone that we're here, we're open for business, and that there can be some degree of policy certainty.
Well, I do have more questions, but we don't have enough time. Gary, thank you so much for your time and insights as always. Gary Boyson, he's a portfolio manager at Rand Swiss.